Hello and welcome to Capital Market Live from Channels Television, where you get an in-depth analysis of how your stocks performed for the week and other market events. I am Will Ibang. Now let's get a quick summary of market close for major indexes. I will begin on the global scene. European markets held in positive territory on Friday as traders around the world assessed key November jobs report out of the US. Now the Pan-European Stock 600 index closed up 0.7%. Travel and leisure stocks added 1.5% to lead gains, while mining stocks fell 2.3%. Now in Asia, Japan's Nikkei 225 tumbled 1.68% after the GDP data to end at 32,307 points, its lowest level in a month. Now, Hong Kong's Hang Seng Index erased earlier gains to trade marginally below the flat line in its final hour, while the mainland Chinese Shanghai gained 0.11%. Now in the US, all three major indexes gained ground as the Dow Jones Industrial Average and S&P 500 broke three-day losing streaks ahead of Friday's all-important jobs report. Now the S&P 500 rose on Friday to hit a new high for the year after the November jobs report and the University of Michigan consumer survey data signaled a resilient economy and cooling inflation, fueling hopes for a so-called soft landing scenario. Now back home to the domestic equities market, where despite profit-taking activities during the week, the local stock market edged slightly higher, driven by increased investors' demand for NIBSS Holdings, which is up about 12.2%. ETI and FBN Holdings. Now, the week's notable highlight was FBN Holdings' impressive 7.7% gain, which increased the stock's market cap value by 856 billion naira. Now, the all-share index rose by 0.17% week on week to 71,541 points, with month-to-date and year-to-date returns in positive territory. Now, despite the marginal increase in the benchmark index, total volume traded was weak as it decreased by 5% week on week, while the trade value increased by 16.4%. Now, on a sectoral level, performance was mixed, with gains seen in the banking and consumer goods indexes, while the industrial goods, insurance, and oil and gas indexes declined. Multiverse Mining and Exploration PLC topped the gainers chart for the week. We see Thomas Wyatt remaining bullish this week as well, while Consolidated Hallmark Holdings led the decline in stocks. And the trio of Universal Insurance, UBA, and GTCO topped trades by volume. Similarly, the NASD unlisted securities market closed positive. The NASD securities index climbed over 2%, taking the market cap to 1.2 trillion naira. Also, turnover for the week shot up through the roof. Volume rose by more than 500% to 27.74 million units traded, while value advanced by 260% to 157.69 million naira. Now, Double One PLC retained its position on the gainers leaderboard, while NASD PLC recorded the most significant loss for the week, and Geofluids emerged as the stock investors traded the most by volume during the week. Now we have joining us virtually from Winnipeg, Canada, Mr. Abiola Razak, former economist and former head investor relations at United Bank for Africa, that's UBA. Good to have you join us this evening, Mr. Razak.
Hi, Will. Good evening. Thank you so much for having me.
It's good to have you on the program. So we're just looking at the whole market performance. I want to know, what's your take on the equities market performance this week?
I think the market has done pretty well this year. If you look at the year-to-date performance of about 39%, I think that's really impressive, especially when you look at it from the perspective of the opportunity this provides for investor. This is a return that beats inflation rate. And beyond that, this is a consolidation of the bullish run that we've seen in the market since 2020. You recall the market gained about 50% in 2020, the year of COVID. We saw a slight gain of about 6% in 2021. 2022, the market was up almost about 20%. And this year, we've seen about 39.6. This week in particular has been relatively weak, I would say. It's been a roller coaster ride for the equities market. Like you rightly know, the equities market on a week-to-day basis only gained about 0.12%, largely on the back of some profit-taking that we saw in stocks like First Bank, for example, and a few other stocks that investors are beginning to take profit on, particularly within the banking sector as well as within the consumer space. Okay. I do think that been a relatively strong performance for equities overall.
Now, you mentioned one bank that I'm very much interested in talking about, which is First Bank, that's FBN Holdings. Let's throw a spotlight on that. One of the tier one banks in the country. It's gained 160% year to date this year. And also, we've seen it crossing into the league of suits. There's a stocks worth over 1 trillion naira. What's the outlook for the share price going forward, as seeing that it has crossed this 1 trillion naira market capitalization? And what factors do you think contributed to it crossing this milestone?
Yes, you are very right. We saw First Bank on Wednesday precisely crossing the 1 trillion naira market capitalization threshold. The stock gained significantly over the last 3 months in particular, particularly following the announcement of the Q3 results. We saw significant rally because it reinforces the strong recovery that we've seen in First Bank as an entity. But over and above that, I think it's also important to say that First Bank, from a valuation perspective, remain very cheap. Even at the current price of 23 naira 85 kobo, it's still just about 0.6 times price to book. It's still priced at just about trailing price to earnings of about 3 times multiple. That's significantly cheap, irrespective of the benchmark that we decide to use, whether we're looking at it from an emerging market perspective or we're looking at it even from a relative multiple perspective with other Nigerian top tier banks. But I think it's really important to focus a bit of attention on 3 important things that might drive the share price of First Bank, and not necessarily about the performance of the bank. Those 3 factors would remain investors' perspective around the ability of First Bank to sustain the earnings recovery, which I believe that there's potential for First Bank to be able to do that. We've seen significant improvement in terms of the earnings capacity, both on the interest income as well as the non-interest earnings, particularly with the e-banking business growing significantly over the last 3 years on the back of the agency banking, which I think today happens to be one of the most expansive agency banking within the banking industry. But I think over and above that, investors would also be critical about the ability of First Bank to be able to demonstrate that they've significantly and perhaps totally clean up the balance sheet. If you recall, over the last 4 or 5 years, First Bank has been dealing with the non-performing loan ratio, and of course, they've been trying to clean their balance sheet to ensure that they achieve a relatively decent asset quality. I think they've done significant level of work in that. However, with the high interest environment and without seeing interest rates potentially even rising further with the increase in yield environment that we've seen over the last couple of months, I do think that investors will begin to focus on the risk of new NPL formation in First Bank. And that's not particularly about First Bank alone. I think the higher the interest rate environment, the higher the probability of default that you're likely to see in the loan portfolio of banks generally. And this is something not peculiar to First Bank alone. So investors would be critical about seeing how that plays out, especially that First Bank balance sheet is about 60% dollarized on the loan book. About 60% of the loan book today is in foreign currency. With the level of depreciation on the naira that we've seen even in the official market, while that might be positive for earnings in terms of revaluation gains, but it might actually become a significant source of risk for the quality of First Bank assets. And I think that those are the critical factors that investors would like to see, how First Bank demonstrate their ability to be able to manage this risk going forward. From a valuation perspective, like I said, it still remains very, very cheap. However, I do think that from where we are today, First Bank stock might begin to maybe slow down a bit, and the reason for that is largely on the back of these fundamental factors, as well as the capital reason that we expect to be announced. Earlier in August this year, at the annual general meeting, the bank had announced that they would like to do a 150 billion equity capital raising by way of rights issue. Initially, the plan, based on the estimate and based on the information that was provided, the rights issue would have been done maybe at 17 naira. Now that we're seeing stock trading at 23.85 levels, and the possibility of even the bank increasing the amount of capital that needs to be raised, given the new indication of the Central Bank of Nigeria to actually recapitalize the banking sector. I think there could be a possibility that investors might be concerned about the ability of First Bank to be able to push through, and that might begin to put a lead on the share price. But I do think that from a valuation perspective, it looks very attractive, irrespective of the metric that we decide to use, whether it's price to book, whether it's price to earnings.
Okay, let's take this to the broader sector of the overall banking sector. I mean, what's your perspective on that industry and what should investors be focusing on?
I think for now, capitalization would be the key risk the Nigerian banks will have. Quite a number of banks apparently would need to raise additional capital, particularly tier two names. The tier one banks, I would say, are relatively more capitalized than the tier two banks. But the overall sector, as it were, is sitting on a capital adequacy ratio of just about 13% based on my estimate. And that's below the 15% capital requirement for the tier one banks. The tier one banks, many of them have just between 200 and 300 basis points buffer over and above the minimum capital requirement for international banks. And I do think that with a new level of depreciation of the naira that we've also seen in the official market, you might recall that yesterday we saw the NIBSS fixing for the first time since the liberalization of the FX market. And FX fixing lost about 30%. The naira weakened about 30% in the official window from just about 863 naira to about 1,099 naira to a dollar. That's about 30% weakness in the naira. And given the level of dollarization of Nigerian banks' balance sheets, this will significantly affect their capital ratios. Whilst they might book FX revaluation gains on the back of this naira depreciation within the official market, it significantly affects their capital ratios, and this would potentially increase the level of capital that needs to be raised. I think investors will want to focus on how banks would recapitalize. I do think the opportunity is there for the Nigerian banks to be able to tap into the market either by way of the right issue or by way of offer for subscription or new issues of private placement. But definitely investors will want to see how banks recapitalize, and they want to see who exactly needs more capital and how much capital does each of the banks actually need. And I think overall that will be the key risk to watch over the next 6 months in terms of share price performance for the banking sector. And that's why I do think that investors would have to take some caution in terms of potential appreciation of share price going forward. We might begin to see some level of profit taking over the next couple of weeks, particularly once the central bank announces clarity around what the new capital requirements will be.
Okay, let's just talk about rates now, the interest rate environment. What's your expectation of the rates going into 2024? And how do you see the interest rate environment affecting banks and the equity markets going forward?
Okay, I think the interest environment will be shaped by three factors. One is the global market itself. We've seen a bit of some very good numbers coming out of the US. We've seen positive numbers coming out of China. As against expectations, the job numbers from the US, the November job numbers were really positive, stronger than everyone had expected. And I think the growth numbers are also very strong. This potentially mean that we might begin to see some bit of early moderation in interest rate environments, particularly in the US. My take is that from the second quarter of 2024, we might begin to see the Federal Open Market Committee beginning to adopt a slightly accommodative monetary policy, I would say. And I think that should give some room for emerging market like Nigeria to potentially be able to loosen a bit. However, there are also some domestic factors that we need to deal with, especially that the new central bank regime has indicated their interest in actually adopting an inflation targeting monetary policy framework. And what that means is the fact that the central bank would seek to achieve a decent level of inflation rate. Inflation currently at about 27.3% means that we might have interest environment remaining high for some time. But I also do think that given the level of liberalization in the FX market, given the transparency that we see in the FX market, and given the expectation of continued reform, both within the financial market as well as within the real sector of the economy, from both fiscal and monetary side of policy side, I do think that there might be potential for an accommodative monetary policy environment going forward. However, that might be possibly maybe towards the end of 2024 when we do see clarity on where the naira settles. I do think that naira trading at 1,099, I think it's an undervaluation of the naira, and I think the central bank will want to see how that settles and what the equilibrium level of the naira would be before they begin to adopt an accommodative policy. So in the initial time, particularly in the first 2-3 quarters of the year, I do expect that monetary policy environment will remain tight, and on the back of that, we might continue to see slight further increase in the yield environment, and of course the lower interest environment will remain tight. In terms of implications for banks,
I just want to say
it's possible.
We want to take a quick break now, Mr. Razak. I know you have a lot to say, but want to take a quick break now. When we come back, capital markets will still be here. Thank you so much. Thanks for staying with us. Now we're still joined by Mr. Abiola Razak, former economist and head investor relations at United Bank for Africa. That's UBA. Still with us virtually via Zoom, and we'll just continue that conversation we were having, Mr. Razak. You were talking about the banking sector, but I just want to quickly go to what the equity market. It has offered a great return for investors this year. What's your outlook for 2024?
I'm relatively bearish for 2024 on the equities market for two reasons. One is the interest environment, like I said earlier, is going to remain relatively high for most part of 2024. And a high interest environment means that it might trigger a risk of sentiment from an equity perspective. What you're likely to see is investors might begin to reallocate funds to risk-free instruments and fixed income instruments in general. And on the back of that, we're likely to see some bit of moderation in terms of the allocation of funds to equities. Over and above that is the capital raising that we do expect within the banking sector. Capital raising exercise means that the primary market might be a lot more active than the secondary market, and people will tend to take opportunities in the primary market as against coming to the secondary market, particularly for banks that might be seeking seasonal equity to be able to meet the new capital requirement that the central bank announced in the early part of 2024. And I think on the back of that, we might begin to see some moderation in terms of price levels, particularly for banks. And like you rightly know, the banking sector accounts for a significant part of the Nigerian equities market, both in terms of liquidity and in terms of the market capitalization. And largely on the back of that, if we do see a moderation in appetite for secondary market interest in banking stocks, we might definitely see some bit of moderation again in the overall NSE index. Like I said again, 4 years in a row, investors are beginning to think of a correction in the equities market. So sentiment negative, fundamentals may also begin to affect it. And of course, largely on the back of all these factors, including reallocation of funds to fixed income instruments, beginning to see yields, for example, on the 20 and the 30-year instrument bonds, sovereign bonds, yielding about 16.5, 16.8% as we speak. That pretty much obtained significant returns, high double-digit return, even though still less than inflation, but that would trigger a risk of sentiment for equities going forward. And it's on the back of that I'm relatively bearish, I would say, on equities for 2024. I don't expect the level of strong performance that we've seen in between 2020 and 2023. I do think that we might see a bit of correction, not necessarily because the counters are overpriced. There's a significant undervaluation of the Nigerian equities market, but largely on the back of sentiment and those other factors that I mentioned earlier.
Okay, so I would say, is that realistic or pessimistic, less optimistic outlook for the equities market? But something happened this week that particularly almost caused a bank run. But on Thursday, the Nigerian banks received a circular from the Nigeria Interbank Settlement System PLC (NIBSS), instructing them to remove non-deposit taking financial institutions such as switching companies, payment solution providers, and super agents from their NIB fund transfer channels. And now this NIB channels encompass USSD, the mobile banking apps, POS, ATMs, as well as web and internet platforms. Mr. Razak, I would just want to know very quickly, this directive from the NIBSS, it might seem like the CBN is trying to clamp down on fintechs, and this is the impression a lot of people have, and they need clarity on this. How do you see this playing out, and what's the purpose?
I think there are two things that we need to clarify here. One is the purpose, like you rightly mentioned, of this and what this actually means. I don't think that it's an attempt to clamp down on the fintech. The Central Bank of Nigeria does support fintech. They license actually many of the payment service institutions. They do license them. The switch providers are licensed by the Central Bank of Nigeria, and they actually operate their business in line with the regulation. However, what the central bank is trying to do is to avoid a situation where people take license, for example, for switching, and they're doing something else. People take license, for example, to become payment gateways, but they're doing remittances. It looks like the same thing, but it's not the same thing. There's a different license, for example, for high MTOs, which is the International Money Transfer Organizations. When you want to take a license for high MTOs, you can get that license separately. It's different from taking a license to be a switch provider and then doing business as an IMTO. And I think what the central bank is trying to correct here is more of a situation where we get at a point where people begin to take license for A, but they're doing B, or they're doing A and B. So what the central bank is trying to do is not to clamp down on the fintech, to the best of my knowledge. I do think what they're trying to do is to sanitize the system and ensure that people do businesses that they are licensed to do. Financial market is a regulated sector, and I think everyone would appreciate the reason why the financial market has to be regulated. It has significant implication for virtually every aspect of our economy and the social environment in particular. And to that extent, it's important that the central bank, as a regulator, is proactive to ensure that people only conduct businesses that they're licensed to do. So it's not a clampdown on the fintech companies, not in any case. But I also do think that this is also an opportunity for banks to step up their game to be able to provide end-to-end services for the consumers. Many people were forced to go to the fintech companies just because of the low level of service and the inability of banks to meet the requirements of the customers from a payment perspective. So fintechs are seen to be complementary. However, fintechs must stay within the business that they've been licensed to do. And I think that's what the central bank is trying to correct at this point in time.
Okay. So let's just consider the role of fintechs in the economy, seeing that they kind of they promote financial inclusion. They seem like the body that kind of helps to bridge that gap between the underserved in the financial community, bring in financial inclusion. Don't you think these regulatory policies might kind of dampen the objective of trying to include people who don't have access to the traditional banks?
I agree with you absolutely. Fintechs are complementary, like I said earlier, to banks, and they do help in terms of financial inclusion. However, irrespective of the merits of fintechs helping to enhance and deepen financial market penetration, it's also important that they do businesses within the remit of the license that they have, and they do businesses in a way that is transparent and must be within the regulation of the Central Bank of Nigeria. Because, like you rightly know, having merit does not exonerate them from regulation. Over and above that is the fact that banks are also building infrastructure to also do similar things that the fintechs are doing. And I think that there is merit in the competition and the complementarity of the fintech companies. But what is also important is that irrespective of how good it is, it's important that they abide and comply. So compliance is a key word. And I think what the central bank is trying to do goes beyond just the fintech. If you look at the recent circulars from the central bank, there's been a bit of emphasis on enhanced KYCs across the entire system, whether it's from retail investors, whether it's from retail customers in the banking system to the institutional customers, and of course even to foreign investors who might want to come into Nigeria. Knowing the customer is very critical, and I think it's important for the sanctity and the stability of the financial market. And I think that we cannot afford a situation where we begin to see people lose money on the back of fintechs just because the central bank does not know what they're doing, and the regulation of the central bank only covers one aspect of their business. And that's what I see here.
All right, Mr. Abiola Razak, we do hope that these, policies and these regulations, meet an expected end as to serve the end user, the consumers in the society. Thank you so much, Mr. Abiola Razak, former economist and head investor relations at UBA. Many thanks for your time this evening.
Thank you so much for having me. Really appreciate it. Enjoy the rest of the evening.
Now we'll move on to other stories where the Nigerian Exchange, as the NGX, is stepping up its financial literacy training, and this time it is taking it to the men and women who put their lives on the line to protect the country. Let's see what they did.
Training.
The whole focus of the XLEAD program is to go out. It's bringing NGX and the market closer to individuals and to people. And so for the armed forces, we intend to be doing this on a quarterly basis, and we're going to go around the country in terms of speaking to the armed forces. We also have a package for the market women. We have a package for the civil servants. We also have a packet for the Gen Zs. So the idea is we want to bring the market closer to people. We want people to understand that the market is accessible. This is something that you can do. It's easy to understand, it's easy to invest, and more importantly, it's easy to grow your money in a way that ensures that your investments are secure. We have brought this initiative to the Nigerian military because we want to give them an opportunity to be able to grow their income and live better lives. They have sacrificed so much for this nation, and they continue to do so, not just them but their entire families. We feel it's important for them to have an understanding of finances and ensuring that it grows at a certain level that can actually make an impact in their lives.
Fantastic move by the NGX there. I do hope the men in the military take advantage of this because they sacrifice their lives for us and they deserve economic empowerment. And that's it on Capital Market. Join us same time next week. Don't forget you can watch this again on our channel's television page on YouTube. Also follow us on our other social media platforms to get updates. I'm Will Ibang. It's bye-bye for now.